Module 4, we're going to consider basic principles of raising capital. In this, we'll be hitting chapters 8, 9, and 10. A common occurrence in the world of sport is the push to obtain funding for facilities. And oftentimes we call these public facilities. Where do we see this money coming from? If the city of Houston wants to build a new park for skating, how do they go about obtaining funds to do this? There's a number of ways, and we'll be talking about some of these throughout our modules. We can take loans. There's general obligation bonds, there's project revenue bonds, there's tax revenue bonds, there's certificates of participation. We also have tax incremental financing, and other ways are tax exemptions and tax rebates. Okay, here are 4 primary categories that we can talk about as sources of capital. First, this thought comes from equity investors, or investors that purchase a portion of the business through stock. And they would do this because the investor believes there could be a future return through capital gains or paying of dividends on that stock. Another source of capital is through debt obligations. These are long-term bonds, and the bondholder is interested in receiving an appropriate rate of return on the investment, and these are low risks. Short-term loans can also be a way to source capital. They typically are used for suppliers of merchandise or raw goods that are used, and they're typically within 30 days is when the business will pay, or the buyer will pay. Very short term. Also, the government has developed what is the Small Business Administration. These are used to aid and counsel and protect the interests of the nation's small business community. And in doing this, they offer loans. And they have them to be paid back in 6 years at an 8 to 13% interest. Another way to raise sources of capital is through self-funding. How do we do this? It is where organizations within themselves seek to raise the capital. They can do this by retaining profits, investing their money in liquid assets. They can also sell tickets and membership prices or increase those prices in order to help raise more capital. Some organizations have gone through to sell sponsorships and have naming rights or TV rights. They can also sell off assets of the corporation. Self-funding can be a common way that sport organizations or even partnerships utilize to raise capital to help fund their business or organization. What are some short-term ways that capital or funds can be raised? Remember early on we talked about short-term and some of it in kind of this 30-day window. We'll also talk about short-term in somewhat of this yearish window. So one of the ways this is commonly done is through accounts payable. This represents amounts owed to vendors and suppliers for services that have been rendered or delivered. Let's think about this example. You purchased items on your corporate credit card, or you bought office supplies and inventory with a bill at the end of each month. You then usually need to pay within 30 days of receiving the bill. So in reality, you've created short-term funding by pushing off that accounts payable for a few 30, sometimes 60 days. Sometimes there's a problem with this, because the problem with accounts payable is that the often slow turnaround time for repayment. So if you are on the other end of that, it can be slow turnaround time for you to get paid. Bank financing is another way to raise short-term funding. Typically there's economical and flexible means to get short-term financing. We could have term loans that are a little longer. They can be 3 to 5 years, or you can use collateral. This is money that the company already has to secure a loan. They may consider using physical property, buildings, inventory, even accounts receivable If a business defaults on a loan, though, the bank can seize whatever was used to secure the loan, whatever was the collateral, whether it was that physical property or the land or even the accounts receivable. Here are a few more ways to raise short-term funding. Commercial paper is one. It's a promissory note that can mature in 1 to 9 months. It's typically common among some large manufacturers and sales finance companies. There's also private placement. This is a process of obtaining funds from private parties, such as investors or venture capitalists or other companies interested in investing. Other ways to raise short-term funding or capital is private companies. Small business investment companies can provide either some type of debt financing by issuing long-term loans or equity financing. You also can think about private investment group. This is money that's pooled from a variety of sources, whether it's individual endowments, pension funds, private investors, and institutional investors that are utilized on the short term to help fund or raise capital. So what are some ways that we could utilize long-term funding, and when is that important? So typically traditional forms of long-term funding are in stocks and bonds. We've seen this, for example, when professional organizations seek to build facilities. They may issue stocks and bonds that are usually paid out over a longer term. Medium-sized or smaller-sized businesses may use mortgages or even these kind of long-term loans to help raise capital. Let's talk about a couple other ways to make or generate long-term funding. First is mezzanine financing. This is especially for those organizations or companies that have a lot of growth potential, but they're not yet ready for a stock offering. So this allows those companies to raise somewhere between $1 and $20 million. And it oftentimes is a combination of not only borrowing money from and then also selling some stocks to those ultimately same investors. Venture capital looks a little different. It's for those organizations or companies that are right at the cusp of going to become a public offering or going to be traded on the market. So someone or a group of people that believe they have a highly marketable product that will be profitable might invest or take risk in owning part of this company in exchange for their investment. And the goal of a venture capitalist is that this company then would go public, and through that public offering, the venture capitalist can make multiple times over their investment. A very common way we see in raising long-term funding or capital is through common stock. This is the most frequently issued and utilized stock. It represents an equity ownership right in a company. However, it's low on the repayment list because secured creditors are repaid and holders of the preferred shares, which we'll talk about in a minute, are paid first. It's usually low risk. We also see this common stock is utilized in mutual funds. What is this? There are purchase a numerous shares of various stocks using money from different investors, including institutions and individuals. Oftentimes you might find that retirement of individuals is done through this kind of mutual funding. Again, a mutual group of people invest in various stocks. What happens? Professional administrators of each fund analyze each stock and try to pick the best time then to buy or sell the fund's shares. Also, low risk. Those that are involved in common stock and mutual funds are involved for the long haul. The return on their investment is a long-term deal. Preferred stock is also issued and as a way to generate long-term funding. Individuals that are owners of preferred stock do so because the preferred stock carries a dividend preference, and it gives preference over those who are just common stockholders. So what does that mean? The dividend is cumulative. It is not paid to holders of preferred stock in a given year. The next year the corporation will owe 2 years worth of dividends. So there are some other benefits that are available for preferred stockholders. They include the following. You have a right to dividend payments. You have voting power under limited circumstances. There's a strong redemption of provisions, subscription privileges to future stock offerings, and the right to convert preferred stock to that less risky common stock. As an owner of stock, you become a shareholder, or one at which holds share in a company. And shareholders have a number of rights. These are often granted legally through our system in order to maintain our market. I've listed these shareholder rights here in this slide. Shareholders have a few more rights than the ones I listed on the prior slide. This looks a little more in depth into some of those key rights. First of all, shareholders have preemptive rights. This protects a stockholder or the company from power of control and prevents that dilution of the stock. Shareholders also have voting power or voting rights. They have the ability to cast a vote for each share that is held to elect board members. They also have holding companies. This is where parties can obtain control by investing in a company. Some companies become involved in defensive tactics against shareholder rights. This is where we are talking here. First, there's a hostile takeover. This is an unwelcome attempt to purchase the shares of a company by the stockholder. There's also what's called a golden parachute contract. This requires huge payments to executives if those executives are terminated. There's also warrants. This is where management can buy shares at the fixed warrant price, which will allow them to purchase more shares. This ultimately, though, can discourage hostile takeover attempts. Recall that the purpose of this module, Module 4, is to discuss basic principles of raising capital. Now remember, one of the ways we can raise capital is through stock, and we've talked about that at length in some of the previous slides. So, what are some of the advantages and disadvantages of using stock to raise capital? I've listed those here. A couple of those include, one of the advantages is that common stocks, remember we talked about that just a few slides ago, do not carry any fixed maturity date at which they need to be paid. It's an advantage of issuing common stock. Also, issuing common stock can help raise new capital without affecting the company's bond rating. At times, such as when interest rates are low and the demand for bonds is also low, it's easier to sell common stock. So what are some disadvantages? Issuing bonds or commercial paper provides a predictable fixed cost for repayment in contrast to those stocks, which represent a stake in the company's future profits. Some investors may see issuing new stock as a negative sign that the company needs to sell more of itself in order to survive. What are some factors that influence stock value? And as you know, throughout this term, y'all are involved in a stock market project. So what are some factors that might influence some of those stocks that you hold? And these can give you some idea of maybe if it's a good or bad idea to buy or sell. So what are some external factors? Think about this. Antitrust decisions affect the league. Labor disputes affect the league. Environmental regulations, safety rules, new rules related to employment, such as classification of food vendors as employees rather than independent. The folding of a rival league or the success of another league ultimately might impact externally those stock values. So what are some things internal to an organization that might impact its stock value? Potentially trading a star player, maybe hiring a new coach pushes up that value. I would argue that the value of the Houston Rockets, for example, went up when James Harden became a member of the team. Another way to increase stock value is to increase the number of preseason games. That means more tickets are being sold. Also, you can borrow money for expansion or issue more stocks. Another way is to declare a dividend or a payout. Consolidating television and radio broadcast operations in-house is another factor that may impact internally an organization's stock value. Now that we've talked a little bit about stock, let's consider and talk about another portion for long-term funding or capital through bonds. A bond is an obligation that needs to be repaid with interest. It's similar to a loan from a bank. These are typically issued by larger corporations or government entities with a good repayment history. Bonds have financing characteristics of loans, as well as a market in which they can be bought and sold, like stocks. We'll talk a little more about bonds in the next few slides. Corporate bonds are one of the ways that long-term funding is generated. This bond is similar to a long-term loan. It's a contract under which the borrower agrees to make specific interest and principal payments over a specific time period. There are many bonds, and we're going to talk about these in some capacity throughout the remainder of this module. We're also going to learn that one of the ways that a number of public facilities are funded is ultimately through bonds. What are the pros and cons of financing through bonds? And then we'll go on in the next few slides to talk about the types of bonds. But first of all, what are the advantages? First of all, the interest on bonds is tax deductible. This might be one of the greatest advantages. Therefore, the interest that an organization must pay back on that bond, they are able to deduct it in their taxes, which ultimately may give them a tax break. Bond financing with that token, can be reasonably inexpensive for a company that has a good credit rating. They're likely to get a lower interest rate, and again, they can write that off on a tax deduct. Also, there's a strong established market for trading and issuing bonds. It's fairly common. So what are some of the disadvantages? An interest is a fixed charge. Regardless then, the company is going to have to pay back, whether they earned money or not. Also, the loaned amount that the bond was issued for has to be paid back in full when the bond matures over that long period of time. Issuing bonds can harm a company's credit rating. If a bond is secured by collateral, a corporation may not be able to sell or otherwise dispose of the asset without the bondholder approval. Think back to what we talked about earlier, that institutions or organizations put up, say for example, machinery and or land or property for collateral. That is the case in the issuing of a bond. The bond cannot be secured, or excuse me, if the bond is secured by collateral, that corporation can do nothing else with that product, i.e. the land or the machinery, without the discussion from the bondholder. So two types of bonds we have right here, secured bonds and unsecured bonds. First, if an asset is secured, the corporation does not have exclusive use of the asset and might need to obtain approval before using the asset for various activities. Also, a secured bondholder receives preferential treatment. That's our discussion of secured bonds. What is an unsecured bond? These bonds provide the greatest flexibility for the issuing corporation, but there's minimal protection for the bond purchaser. Therefore, only those companies with the best credit rating can issue some of these unsecured bonds, which makes sense. There's debentures, subordinate debentures, and then also bearer bonds. Primary concerns associated with bonds is ultimately determine what the appropriate interest rate to attach to that bond is, and how many bonds should be issued. This makes sense. Bonds with high ratings have lower risk, and therefore, though, they pay lower interest or returns. Bonds that have those low ratings are risky, and sometimes even classified as junk bonds. And in order to do so, or to have these junk bonds, corporations have to pay a much higher interest rate to attract someone to invest in this risky bond. Demand for long-term fund arises from four major sources: mortgage borrowing, corporate bond financing, state and local government bond financing, which we have seen often in sport, especially high school, and then long-term U.S. Treasury borrowing. So what is the cost to an organization or even a city for issuing bonds? The primary cost associated with them is the required interest payment. Payments are due in those forms of interest on a semi-annual basis for as long as that bond is outstanding. There is a discount or risk premium at which bonds are sold. For example, if a discount for a $100 million bond issue is $5 million, The issuing or selling entity for the bonds would take $5 million or 5% as a fee to process and help sell the bonds. Because a bond is viewed like a loan, bond repayment ultimately occurs when the bond matures and the issuer of that bond has to repay all the remaining obligations. Here are 4 ways that repayment can occur: sinking funds, serial bonds, bond redemption before maturity, and convertible bonds. We're going to talk about each of these in the next few slides. Here are our first 2 ways to discuss loan repayment. First is sinking funds, and this is probably the most common technique. This is setting aside money in preset amounts or on a variable basis in order to be prepared to pay off the loan when it comes due. Second are serial bonds. These are issued with maturity dates at predetermined redemption dates. They're often issued by states and municipalities that have fairly reliable tax revenues, and those tax revenues come in at predetermined redemption dates. Our third consideration on loan repayment is this concept of bond redemption before maturity. This is done when interest rates change both for the good or for the bad. That is, corporations use newer bonds with more favorable interest rates and use the proceeds from those newer bonds to buy off the older bonds in the open market. If a bond is not callable, a company can purchase a bond on the open market or from a bondholder who's willing then to exchange it voluntarily. This often results in a quicker loan payment or payoff with those better interest rates. Our last discussion on the repayment of loans is this notion of convertible bonds. These are where bonds can be converted to common stock. They're designed to redeem themselves and retire the debt through converting the debt to equity ownership. Buyers often prefer this convertible bonds because investors can obtain interest payments on their investment, but they can also choose to switch to the equity ownership if the corporation starts to experience significant growth. Buyers also prefer convertible bonds because they will retain the position of a secured creditor but also have an option to purchase stock. In the world of sport, government-issued bonds typically represent the most likely funding source for publicly financing projects such as stadiums and arenas. The primary types of government bonds are general obligation bonds and revenue bonds. Our first government-issued bond are general obligation bonds. We see this common in the building of new arenas and facilities. They're often called full faith and credit obligations. So how are these done? The city, county, or even state or other local governments pledge to repay this bond or this loan with existing tax revenues, or even by levying new taxes. This is where it's arguably the most controversial. Organizations ask that communities generate or add new taxes or tax their citizens additionally in order to help pay off these general obligation bonds or to help fund facilities. Strength of the tax base is one of the most important criteria for general obligation bonds. Small cities look different than large cities because small cities have smaller tax bases. Large cities, on the other hand, oftentimes have larger tax bases because they simply have more people living in the area. The second type of government-issued bonds are revenue bonds. The tax revenue to support repayment for these bonds comes from the project itself. For example, an entrance tax may be charged per ticket to a sporting event, and all of these revenues from this tax would be allocated to the repayment of the bond. Also, it may be that in a new facility construction, luxury boxes are potentially taxed, and that tax money is set aside to help pay off the bond. In addition to the notion of the project itself paying off government-issued bonds, there are also a number of taxes that are implemented as repayment sources for government-issued bonds. Utility taxes, we talked a little bit ago about ticket surcharges, real estate taxes, specific sales tax, tourist development taxes. Tourist development taxes may be on things such as hotels, rental cars, because typically in a community, those individuals that utilize hotels and or rental cars are potentially tourists. We also may tax things like restaurant sales, also excise or sin taxes. Those are on things such as alcohol and tobacco. Lottery and gaming revenue at times is used to help pay off these bonds, non-tax fees such as permits, and then lastly, general sales and use taxes. These are all ways the government adds additional taxes to help pay off issued bonds. All right, y'all, we find ourselves at the end of Module 4. Once again, this module has been rather intensive and heavy. So here are some questions for thought. Use these to fact check and use them for application.